welcome to America's Commercial Real Estate Show, your source for market intel, forecast, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by C5 Plus CCIM Global Summit. Now, this is the commercial real estate event of the year. It's a global summit. This year it's in Chicago. It is September 16th through September 18th. You really want to attend this. I've attended it several years in a row. I've spoke there several years in a row. It's a great event, great for networking, deal making, investing, and just meeting people and networking. So check it out. Learn more at c5summit.realestate. Wow, let's learn more about the commercial real estate market, the economy, and industrial real estate. It's a lot of going on around the world and around the country. How's it impacting logistics, the economy? What's happening with industrial real estate? Are we going to get more manufacturing back in the U.S. sooner or later? How is all this affecting retailers and their use of warehousing? And ultimately, what's it doing to industrial real estate? You know, industrial real estate's been a really nice class, a really great sector for investors for the last several years. So, what's going on now, and what should we expect in the future? Please welcome my guest. It's Ermengard Jabir. She is a director of economic research with Moody's Analytics. Ermengard, good to see you again.
Good to see you as well, Michael. Thank you very much for inviting me back.
Let's start with, overall in industrial real estate, sometimes we see headlines that there's a lot of big boxes empty, but then we see, on the ground as brokers in the Southeast, just a heck of a lot of activity in all of our industrial properties. What's really going on out there for performance right now?
Generally speaking, performance is stable. So certainly we are far away from the highs of 2021, 2022, but it's still very much positive. So what we're seeing on the ground, as it were, whether it's by region, you mentioned the Southeast, or at the national level, things are generally stable as everybody really engages in a wait and see approach. So if we think about recent performance, we are at around 7% vacancy at the national level. Rent growth is about 0.3%. That was what we saw in the first quarter. We're expecting a similar figure in the second quarter as well. Preliminarily, also in the second quarter, we're expecting a slight uptick in the vacancy rate, but really not by much. We're talking a few basis points, 10, perhaps 20. So generally speaking, still in decent condition, but yes, not where we were in the early 2020s. Again, I think I've mentioned this before on your show, we're still in much better shape than pre-2020 for the industrial sector. We're on a new, higher, better growth path.
And to put it in perspective, a 7% vacancy, how does that compare historically?
Historically, so if we look at a 10-year average pre-2020, if we break it up by warehouse distribution properties or flex properties, it was much closer to 11, 12% pretty consistently. Double digit, certainly.
I see. So 7% is it's really a strong number then. Very. And rent growth, that seems a little slower than we've had in kind of the go-go days, right?
Certainly. There's been a tremendous amount of deceleration over the past really about 2 years now. Certainly 2024 was a big period of deceleration in terms of rent growth because we saw a drawdown in demand. So demand was still high, but in terms of new demand, there was a deceleration in new demand. And so from that, we've seen much more moderate rent growth. But again, if we look back historically, 0.3% on a quarterly basis, if we think about where 2024 ended in terms of rent growth, nearly 2%, both for warehouse distribution properties and for flex properties, it's still much higher than the average annual pre-2020.
When you talk about demand decelerating over the last couple of years, was that really in the big box? What type of industrial are you seeing different demand variables?
In larger spaces primarily, although there is still, again, it's a very geographic, regional story. So depending on what market you're talking about, there still is a significant amount of construction that's being uh, built to suit. But generally speaking, what we are seeing is larger properties are not necessarily as in demand as they were previously. But if we look at flex properties, they're doing remarkably well. They're actually performing better from a vacancy perspective than warehouse properties.
Yeah, and I think a lot of I don't know about most of my listeners maybe, but at least me, when sometimes I think of industrial real estate, I think of the warehouses and I think of the big boxes and the medium boxes and in the cross docks and in the spaces that smaller companies are using kind of locally. But what about manufacturing facilities? What do you see there, and what do you expect moving forward there?
In the early 2020s, again, it's strange to say, but we're already halfway through 2025. We saw an acceleration, really exponential growth in the amount of construction spending on manufacturing. It peaked exactly a year ago, June of last year, 2024. And since then, we've seen it trending downward. So it's lower than its peak. It's still, again, looking historically, it's still much higher than it was for many years, but it is trending downward now.
You're in economic research, so I have to ask you, what what do you expect moving forward, kind of related to America first and the tariffs and the president trying to get manufacturing and jobs back in the U.S. Any expectation at this point? Any signals?
So if we look back to a few years ago with legislation like the CHIPS Act, for example, what we saw was definitely a resurgence of interest in nearshoring and reshoring, driven pretty significantly by supply chain disruptions that we saw due to the pandemic. Now, as time progressed and things changed, trade opened back up again from, again, a COVID perspective. The fact that it takes more money than people expect, I think, in many cases, to bring manufacturing back to the States, and it also takes more time. The sorry, we're gonna have to cut this little part out. It often takes more time and more money than many expect to reshore production. And so what we saw was there was a bit of a pullback in the desire to continue down that path. Now, having said that, we've moved forward a few years, and there is once again a resurging desire for, I would say, more now reshoring than nearshoring. A few years ago, it was more nearshoring to Mexico, Canada. We saw properties along the border, so whether it was the southern border, the northern border, so McAllen, Laredo, El Paso, Detroit, industrial properties were doing remarkably well because of these nearshoring efforts. Now it's perhaps more focused on a reshoring effort. Having said that, again, it takes more time, more money. And then there's also a component that is frequently not necessarily talked about as much, which is the labor component. There's a need for skilled labor for a lot of the manufacturing, and there perhaps aren't those population centers that have a high level of the skilled labor necessary. But of course, that's not a huge impediment because you can always find labor.
Yeah. New supply, or the lack of new supply, the slowdown has really impacted multifamily and office and retail, and I guess you'd say in a good way. What about industrial? Was there really a slowdown in supply there at all?
There has been, and that's been a really wonderful factor for the industrial sector. The fact that we've seen new supply decelerate quite substantially, quite rapidly. And of course, that has to do with the fact that industrial, unlike the other core four property types, has the shortest amount of time to be built. So you can build it quickly, but you can also stop building reasonably quickly without having a project actually underway. You can stop in the planning permitting stages. And so that's been remarkably beneficial for industrial. And that's why we've been able to see, although much lower, still positive rent growth consistently at the national level. There have been pockets where we've seen some rent decreases in particularly for warehouse distribution, also for flex, at the market level, at the submarket level, but certainly at the national level, still positive. Industrial remains the only sector that hasn't given back any of its pandemic era performance gains from a rent growth perspective at the national level. Again, it remains positive. Vacancy, yes, it's up from the record low rates, in the 4% range. Having said that, it's, still reasonably stable because we have seen a significant reduction in new construction.
Based on what's going on around the world and around the U.S., I mentioned it in the opening, some of that. What do you expect moving forward for industrial real estate performance?
One of the major things to really look out for, I'll say for industrial, but generally speaking for all property types, are the knock-on effects of geopolitical tensions. And of course, one of those is related to the potential for oil price shocks. So generally speaking, we've seen retailers more recently engage in just-in-time inventory management systems. And so what that really means is that they're not holding as much stock. They're holding just the amount of stock that they need for the current level of demand. Now, depending on how things could potentially turn out, and I unfortunately don't have a crystal ball, they could change their inventory management systems to hold more stock, which would require more warehouse space. Conversely, depending on consumer behavior, and we have seen a bit of a reduction perhaps is too strong of a word, but a bit of a normalization in terms of consumer spending versus really exuberant growth in consumer spending. So it's possible that they won't need to store more goods. So really at the moment it could go either way, but certainly these are shocks to look out for. Having said that, another mild headwind, because it is mild, is the fact that the growth rate for the e-commerce share of retail sales has been flat over the past 3 quarters. In fact, there hasn't been any growth. And so the share has stood at 16.2% for the past 3 quarters. And so that really indicates that the need for more warehouse space, more distribution space at the moment to support growing e-commerce isn't quite there.
If you will, dive in a little bit more on the oil price potential spikes in prices there. What do you expect, or if they come or not? What do you think that hurts the economy, consumer spending, and overall property types, including industrial, or what?
So I'll speak more generally to economic theory on that topic, which is that if we do see an increase in the cost of oil, in the cost of energy, it greatly impacts transportation, and the industrial sector is really reliant on goods. And so if it costs more to transport goods, then the cost of goods will go up, and the either intermediate consumer or the final consumer will have to bear the cost. And typically when prices rise, demand tends to fall. Now, of course, we must never underestimate the ever resilient US consumer because we're expecting to see strong GDP growth in the second quarter. certainly compared to the first quarter. But having said that, there is the potential for that, which has knock-on effects for warehouse distribution properties, for example. Then if we think about the broader set of CRE properties, retail would be another property type that would experience a similar cycle because it is goods based as well. And if we think about the apartment sector, as if there were a situation where prices rise, that cuts into household discretionary incomes. And so what ends up happening there is if people have to make trade-offs between the cost of rent, for example, or mortgages versus the cost of goods, particularly non-essential goods, certainly there will be a trade-off away from goods spending and more towards spending on essentials, and shelter is certainly one of them.
And did you say that some of the retailers have gone to just in time as far as warehousing rather than just in case? Because didn't they kind of go more just in case during COVID issues?
They did. They certainly did. And, that was not necessarily the main driver behind higher demand, but it was certainly spurring higher demand for warehouse properties. And so, the move to just in case, rather just in time inventory management systems really means that they can store a lot of the goods in their retail locations versus in additional warehouse space.
Where do you find that we might find opportunities in the industrial world today? Is there a certain property type or geographic area?
I would say cold storage because it's food based. So if you were asking me the question about retail, I would say grocery anchored retail. So cold storage fits into that similar category of really serving an essential market. So food, medicine, and that's, in the event that more general demand slows, certainly people will choose essentials.
Yeah. What would you leave our audience with related to industrial?
The industrial sector is still doing very well compared to its other CRE peers. It's doing well, generally speaking, compared to itself. Yes, it is slower. There is a softening. We did expect at the end of last year, we expected that this year would see a move towards industrial's new steady state, its new equilibrium state, closer to 3% rent growth per annum, about a 5 to 6% vacancy rate. We are now not expecting that to happen this year. However, we're still expecting general stability and progress for the sector into next year.
All right. Well, let's leave it with that. I appreciate it, Ermengarde. Thanks for being on the show with us.
Thank you very much, Michael.
All right. Thank you for joining us around the world, around the country. Please let us know what you think. Please connect with us. Please share the show if you will. And if you're on YouTube or our podcast sites, please like it. Please share it. We appreciate it. We spend a lot of time and money to hopefully bring you some good information. We appreciate you helping us out. So until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By the 2025 C5 Plus CCIM Global Summit, the premier commercial real estate conference for networking, deal making, and investment. For more information, visit c5summit.realestate. For more podcasts and videos, subscribe and visit creshow.com.